Welcome to Commerce Academy. In previous lecture, we discussed what is ledger, importance of ledger, format of ledger, and how to make a ledger account. Discuss with example. So today I am going to again discuss some journal entry how to post in ledger. So to the lecture, attend very carefully. So now I am going to start my lecture. So first I give the overview of yesterday lecture. What is ledger? Ledger means a book in which include all accounts, assets, expense, income, liability and capital. Ledger is also called book of accounts because every account involved in ledger book. So posting means when we transfer entry from journal to ledger is called posting. And format of ledger ledger account has two sides. One side is debit and other side is credit. Both sides has equal columns. So this is the format of ledger. Date column, description means detail, so I mention here detail due to limited place. In detail column we mention the account name, GR, journal book page number where the entry is transferred to ledger, amount of that account written here, date, that is credit side date, and then account name and GR, journal book page number where the entry is transferred to the ledger and amount of that account. And balance, if the debit side is greater than credit side, that is called debit balance. If the credit side is greater than the debit side, then it's a credit balance. So you can all this easily understand when you see this example. So first, cash, started business with cash debit and capital credit. 2005 1st January, this transaction is happened. Cash debit and capital credit. Cash debit due to capital, amount mentioned here 1 lakh. January 2005 January 1st. And capital credit due to cash. Capital account. Capital credit due to cash 2005 January 1st, 1 lakh amount. So first transaction is posted to ledger, first account and second account. Now move to next transaction, purchases from Ehsan, means purchases on credit from Ehsan. Purchases increase because we buy the purchases. When purchases increase, it's debit. So purchase account debit due to Ehsan means account payable. Ehsan is our liability. We pay the sum amount to him because we buy the purchases on credit from Ehsan. So purchases debit due to Ehsan, purchase account. Purchase account debit due to 2nd January. With the amount 30,000. One account posted, now another account posted. Here Ehsan account. Credit due to purchase. So next transaction is cash sale. Cash increase due to sale. Cash on sale. So cash increase and sale also increase. Cash increase due to sale on 3rd January with the amount of 16,000. Sale account means due to cash it's credit on. So posted to the sale. Each and every account posted to own account as separate account, because cash when posted in cash account, capital posted in capital account, purchase is separate account, sale asan. And next transaction is for sale to Ali means we sell on credit basis, means sale to Ali we receive amount from Ali, so Ali is debit and sale increase also credit. So Ali is debit, Ali account 4th January due to sale 10,000. So next sale account is here. So sale is credit due to Ali. Account 4 due to Ali, sale is credit 10,000. So now next entry is cash received, discount allowed. When we give the discount, it means our expense, so it's debit. Discount received, it's our income, it's credit. So we receive amount from Ali 10,000 received. So we give receive a 9,800 and give discount 200, and total amount is Ali credit with 10,000. So cash increase Ali. So Ali is credit because our Ali was receivable, we amount received from Ali, so Ali is our assets. Now it's decreased because we received amount from him, and cash our assets. So cash increase due to Ali means account receivable decrease because we received a payment from him. So cash debit on 8th January with the amount of 9,800. Ali account is here. So Ali account is discount account. First we mentioned debit account. Discount account, debit due to Ali. And Ali credit due to cash and discount. Ali credit cash 9,800 cash and 200 discount. So in this way you can post the journal entry into the ledger account. So in previous lecture we also discussed the importance of ledger. We discussed that we can check the balance of every account from ledger. You can easily get the balance of every account, and also we can take information of any account from ledger. It's a proof, you can easily take information. We spend cash there, and where from we get cash. We can also check the inflow and outflow of cash easily. So also we can discuss the due to ledger account the trial balance make easy. It means the trial balance prepare with the help of ledger. So when we find out the balances, so it's a very easy to make a trial balance. And also discuss the trading profit and loss count is only prepared with the help of ledger account. And now we can find out the balance of these accounts. So 1,16,000 and 1,16,000, 1,25,800 balance here. This is our debit balance because debit side is greater than credit side. So capital account balance, close account on 3rd January, 3rd January. So due to balance next no credit balance. So now purchase account is 20,000, 30,000, 20,000. Sale account balance 26,000, 26,000 balance 26,000. So Ali account 10,000 balance is nil because both sides are equal. Both sides are debit side is 10,000 and credit side also 10,000. So 10 minus 10. So nil. Balance is nil. Discount 200. Discount 200. Balance. January 30. So after this we can find out the balances of each account. After this the further step is prepare the trial balance. In next lecture we will be discuss what is trial balance and how to make a trial balance from ledger account. So practice these and you can own make some journal entry and make the ledger account of those transactions. So keep in touch and we meet in next lecture. Thank you and Allah Hafiz.